Hello and welcome to our series of financial awareness training videos. The purpose of this series of training sessions is to improve the financial awareness of business owners and managers. At the end of the series, you should be able to keep good financial records, produce reliable financial information from those records, and use that information as a key basis for your future business decisions. In this session, we'll be asking, what is a financial model? How do I go about constructing one and the information needed? What benefits will it bring to my business? And can I get the information I need from my accounting system? So what is a financial model? It's an arithmetic representation of your business. The creation of the model should be prepared by key personnel in the organisation who understand the capacity constraints of the processes, these being equipment, staff, stock levels, and customers' requirements. It can be used to check the viability of your future aspirations and highlight what needs to be done to achieve your targets. It will predict future profits and highlight any problems such as cash flow, staff, a need to employ extra staff, the need for a larger mixer, etc. By using a series of what-if scenarios, we can build up a series of possibilities. For example, what would be the effect on your business if your main ingredient doubled in price, or your main customer went bust, or if you took on a huge contract to supply the biggest order you've ever had?
Reviewing profitability by using modelling is closely linked to assessing the mass balance for the business, i.e. understanding where and how much waste exists in the manufacturing process. Modelling can be used to assess the profitability improvement possibilities by, say, reducing waste by 1%, and can generate the momentum and encouragement to search for greater waste reduction in the process.
But it also helps plan for growth. What would be the effect if you doubled your production? Would you have the cash, the staff, and the capacity to do this? Or would you need to go and borrow money from the bank, buy a new machine, or recruit staff? And what are the financial implications of those additional costs? A well-prepared and updated financial model is not a crystal ball, but it is probably the nearest thing business managers will get to it in financial planning terms for the next 3 to 5 years. Constructing a financial model relies on the following elements. Firstly, it must involve the key personnel of the organisation. You'll need input from sales, production, technical, and financial colleagues. The first question to ask yourselves is, how do we perceive our business? Is it a single product for a single market? Is it multiple products for multiple markets? Is it made up of identifiable business units, for example, 2 production locations? Unless you are running a fairly straightforward single product, single market business, you'll need to go through this process to identify the different business streams. There's no absolute definition of business stream, but it should be an element of the overall business where you could or should be able to identify income and expenditure uniquely with it. For example, a particular product that is sold as that product and not part of something else, where you know the ingredients needed to produce it, as well as the labour and machinery requirements. Alternatively, it could be a different route to market, for example, wholesale, traditional retail, or e-commerce. There's no point building a financial model that is more detailed than the actual information available. Another differentiation of streams might be fresh and frozen sales. Once you've identified those business streams, you need to identify what drives the profitability of that business stream. The obvious elements are sales volume, sales price, ingredients costs, productivity levels, and yield. But it's your business, and you need to decide what is appropriate for you. Next, discuss and decide where you'd realistically like the business to be in 5 years' time. Do you simply want to survive, grow cautiously, or scale up? What will be the broad operational requirements? Will you need additional machinery, staff, or premises? When the team is clear on all of these points, it can set about building up a financial model that will test the viability of your plans and aspirations. Typically, this is done using Excel. We consider Excel to be an excellent and powerful tool for modelling. There are other software programs available, but they tend to be less flexible than Excel. and they would also cost money, whereas most people and businesses will have Excel as a matter of course. Let's now consider an example of building a financial model using Excel. This is a jam company that started trading in January 2021, initially through food services and retail. E-commerce sales started in June, and it's hoped in 2022 to start supermarket sales. For the purpose of this model, we have a single product, a 250-gram jar of jam. So this spreadsheet is parameter driven. On the first tab, we have our growth projections for the next few years, which we will have based on discussions with our customers and market trends. We also have the current rates for national insurance and the current VAT rates. We then have a summary sheet which gives us a quick overview of the yearly projections for the business. In this model, the sheets are all linked, and we're going to be putting our income projection and cost of sales into these 4 green tabs. We then put our wages and overheads into these 2 blue tabs, and they will then feed these 3 yellow tabs, which are the 3 main accounting reports, namely the profit and loss, the cash flow, and the balance sheet. So we look back at the parameters tab and we put our sales projection growth in. So we expect food services to increase by 100% in year 2, 150% in year 3, before levelling off at 25%. More modest increases for retail at 20%, and e-commerce and supermarkets will be 25%. So let's go to our first income stream, food services. As we can see, we sell 2,000 jars per month at £2, giving us £4,000 income for the month. You'll remember in the parameters we said sales would increase by 100% in year 2. So we have a projection for 4,000 jars at £2, giving us £8,000 of income. Below our income, we have our cost of sales, and that's broken down into ingredients, packaging, utilities, and wages. At the bottom of the screen, you can see the breakdown of the ingredients. This is our recipe, or our bill of materials, and it shows how much of each ingredient we need to make 1 jar of jam, and that in total the ingredients cost us 89p. This allows us to run what-if scenarios. For example, what would happen if the cost of strawberries doubled? Similarly, if we wanted to change the recipe and use less sugar, or perhaps adding in another ingredient. We can also see the packaging costs here, and again we can do more what-if scenarios, and the same for labour and utilities. If we do this for all of our 4 income streams, when we go to our profit and loss account, we can see that the income and the cost of sales from the individual tabs has been populated in here. And we can now see our gross profit, which is the line highlighted in orange. We need to look at our overheads, including labour costs. So if we look at the labour tab, we can see our staff, which to start with is just a manager and 1 assistant. You can see there are plans to take on more staff as and when trade picks up. You may remember when we looked at the income streams, there were labour costs in the cost of sales. We need to deduct these from these labour costs so that we don't double count. So the line in green shows the total labour costs less those already allocated to the cost of sales. And this is the figure that was brought into the overhead tab. We then go to the overhead tab and we can see the salaries line at the top. And then lower down, we can see the usual overheads, so rent, rates, and printing. Some of them are monthly, some quarterly, and some just ad hoc. We have the total overheads number at the bottom, which populates our profit and loss account here. This then gives us our net profit or net surplus line, which is our gross profit less the overheads. There are lines for interest and tax, but we won't go into these at the moment. The net profit line shows that in some months we make a loss, but importantly, at the end of the year we make a profit. These figures we've entered also populate the balance sheet and the cash flow. The balance sheet is less important for now, so what we'll do is concentrate on the cash flow. If we look at the cash flow forecast, it shows how much we started the year with, which is the £20,000 in the bank. It shows how much money flows into the business and out of the business, and how much cash we have at the end of each month. For this simple model, we've assumed customers pay within 30 days, and we pay our suppliers within 30 days, but we can use this model to see what the effect of allowing our customers 45 or 60 days to pay would be. we've used conditional formatting to highlight the areas where our cash flow for the month is negative. More importantly, when our overall cash in the bank turns to negative. As we can see, in December 2022, we have a negative figure. So this gives us time to take the appropriate action before that happens. We have an annual summary, which gives us, at a glance, a view of our business. As we can see at the start, it's a profitable year. 2022 turns into a loss and back into profit in 2023. So we can now analyse 2022 to see if we need to change things around. Now we have our model, we can start running what-if scenarios to see the effect on our business of various hypotheses. Let's look now at using a financial model. So what are your aspirations? Survive, grow, scale up, world dominance? What can you realistically achieve? Once you've decided what your aims are, you can start to build your model. What you need in order to achieve your aims? More staff, more equipment, bigger premises? Is the market there for your product, or are you looking to add more products to your range? How will you find new customers? And how are you going to fund this? By building what-if scenarios, you can start to fine-tune what different strategies and actions are viable, and the added requirements to implement them. The model outcomes will raise further questions and considerations for you prior to making decisions on key strategic changes for your business. Hopefully the outcomes will highlight problems before you get to them, and allow you the time to put solutions in place to avoid the problems ever actually occurring. In order to gain maximum benefit from your financial model once built, it's possible to link the model to your existing accounting system. For example, Xero, Sage, or QuickBooks. This way the model can be updated with actual monthly financial results, and will then display real-life data and be a truly meaningful tool to better predict future outcomes. To do this, you will need to ensure the accounts package and the model share a common structure, link the chart of accounts from your accounts package to the Excel model, and update the model monthly. If in doubt, reach out to one of the Sustainable Scale-Up team or your accountants for assistance. In summary, financial modelling is an excellent tool to try to predict future financial outcomes for your business. Financial institutions will also require these future-looking models when assessing fundraising requests. The models can allow you to experiment with what-if scenarios to see the impacts on the finances of the business. It's a great tool to assist with business planning and strategic development of your business. And when linked to your existing accounts package, modelling can become a real live working tool, giving management vital data and financial indicators about current and future business performance.